QuickBooks Online 2026. Customer accounts receivable or revenue cycle, sometimes called the sales cycle, the cycle that hopefully eventually results in deposits coming from customers, increasing our checking account. So get ready and some coffee because we're sketching out the bookkeeping process outline with QuickBooks Online 2026. Here we are online searching for the free QuickBooks Online sample company file by typing into our favorite browser, QuickBooks Online Test Drive. Looking for the result that has intuit.com in the URL because Intuit is the owner of the QuickBooks file. We're going to be searching for the United States version of the software, and we're going to be verifying that we're not a robot. This is Ara, by the way.
Hey everyone, this is Ara, your undercover barista/bookkeeper. Looks like QuickBooks just asked me to prove I'm not a robot. Don't worry, I've got my human disguise on tight. Extra foam, zero circuits. Who wants a perfectly balanced latte while we dive in?
So you give the auditor a good latte and they let you in. They don't even check that much. They don't even check. That's how they're anyways, we're on the reports on the left-hand side. We're going to be opening up the balance sheet. Right-click the balance sheet, open a link in a new tab like we do every time. Right-click the profit and loss, open a link in a new tab like we do every time. So we're doing this a little bit more quickly because we do it every time. Let's go to the tab to the right, and then I'm going to close up the pop-ups to get them out of the way, and then change the date range with practicing our data input, typing in 010125, quickest way to do it, to 123125 tab. And then we're going to go up to the P&L, the profit and loss, otherwise known as the income statement, and range change again. 010125 tab, 123125 tab. There's our setup process. We're going to go back to the first tab where we do our data input, closing up the ham boogie. And we're looking in the plus button here. In prior section, we were focusing in on the vendor cycle, the forms in the vendor cycle. Now we're going to move on to the second major cycle, the customer cycle. Now there's only like 3 kind of cycles, but really there's kind of 2 cycles, and then there's a cycle that was created out of bureaucracy, that being the payroll cycle, because the payroll cycle you would think would fit into the vendor cycle, but it's so ugly because of all the bureaucracy and taxes and whatnot that it has its own cycle at this point, right? But now we're going to go into the customer cycle, and the customer cycle eventually would result in revenue coming into the system. Now note that if you're working with small businesses, it's quite common that the vendor cycle might actually be a little bit more uniform oftentimes for different types of industries. Why? Because they're going to be paying things as they become due, and therefore you can automate the vendor cycle oftentimes more often by just basically doing the bank feeds that are coming out of the checking account, or possibly also using a credit card type of system. As you get to larger companies, it gets more complex because then you're going to have multiple transactions, and you're going to have to possibly deal with accounts payable and deal with vendors a little bit more closely to try to get the best terms possible. Or if you have inventory, then you might have more communication with the vendors. But the customer side is often where you really want to focus on the small side of bookkeeping, small to mid-sized businesses, to determine where your niche will be, because there could be drastic changes in terms of how you're going to be managing the customers and tracking the revenue depending on the industry that you are in. So we have then the cycle. We're going to just go over the general process right now with the cycle, and then we'll go into the center, which is going to be on the left-hand side, which is similar to the vendor center. And then we'll go into the actual forms and address each of these forms, trying to determine when we would use the form and when we would not be using the form. So remember, the general outline is kind of the same. If I wanted to do permanent changes, I would go into the cog. That's going to be things like lists and whatnot for the chart of accounts that we're going to set up. If I want to then do data input, I'm going to go into the forms. This is the thing that's going to create the journal entries broken out by cycle. And then if I want to talk to the people that I'm doing business with as the bookkeeper, because my job as the bookkeeper is typically to create the financial statements and, to the degree necessary by the industry that we're in, communicate with the people that we're doing business with. And so in this case, on the customer side, those would be the customers. To communicate with them, we would be in the customer cycle. How much time do we need to be spending in the customer center communicating with customers as a bookkeeper? It depends on the industry that we're in, and it depends if we're on accrual process or not. That's what we'll talk about this time. We also want to think about where do the bank feeds kind of fit in here as well. So let's go over to the flowchart. This is a QuickBooks desktop flowchart, but we're using it to analyze QuickBooks Online or any bookkeeping system, the flow of the customer cycle. Now, when you think about a business in terms of how the flow happens, the most basic question comes down to, is it a cash-based system or an accrual-based system? However, that's not a question you can really ask or shouldn't ask by the whole company itself, but rather cycle by cycle, because it's possible to be on a cash-based system for the vendor side of things, meaning the money going out, the expenses are all electronic transfers, simple for many different types of businesses, for small to mid-sized businesses. But on the customer side of things, you might be on an accrual basis because that's what's dictated by the industry that you are in. What do you think, Ara?
I think you nailed it. Cash versus accrual totally shifts how you handle customers. For cash basis gigs like freelance or retail, you record revenue when the cash hits. So it's super straightforward. Invoice, collect, done. But accrual, that's where it gets spicy. Revenue when you earn it, not when paid. So you're tracking receivables like a hawk. For mid-sized firms, accrual keeps things GAAP friendly, especially if investors or loans are sniffing around. Makes the customer cycle a beast though. Constant communication, aging reports, the works. What's your take on blending the two?
Okay, so what I want to do is focus on the customer cycle and then think about the easiest system to the most complex system. As we do that, you want to think about where do you want to specialize? And remember how specialization works. It's going to be one, do you want to specialize on the thing that's going to be the easiest? The easiest thing will be mean that you can't charge as much as a premium per customer. However, if you're efficient at it, then you can beat people by having more customers. So you're going to be more volume based in order to generate the same amount of revenue. However, if you're specialized in areas, which means you're going to do more complex type of bookkeeping, then you're going to work in particular industries, which might be good because you might just like those industries. They might be interesting to you, and or you're going to get paid more because of the specialization, right? So those are the things you want to kind of keep in mind. So we want to think, what would be the easiest kind of industry? Easiest industry would be, I want to just have everything go through the bank feeds, and when the deposits come through, I just want to deposit that directly into revenue. So you can imagine building your books by just basically the bank statement. Increases to the checking account our revenue, decreases our expenses, and we don't even have to enter them manually from the bank statement anymore. We just connect the bank feeds, and everything that increases revenue, everything that decreases an expense. And because revenue is a bit more specific, in other words, if I go back to my income statement here, when I look at the income statement, this account has a lot of different revenue accounts, but usually, because it's a construction business, but usually most people only have one or two revenue accounts. Why? Because whatever you do is categorized as revenue. I'm not going to put customers in there as revenue accounts typically, because I could break out the revenue account with subledger accounts by customer if I properly put the forms in play. So what I want to do is just there's usually like one account this is what I do. I have sales. I sell stuff. That's the revenue account. What about if I want to break out the kinds of things that we sell, revenue by item? Then there's a subsidiary report that I can run on that. I don't typically want that on the income statement. What about revenue by customer, who we sold it to? Usually there's a subsidiary report for that. Notice that's different than the expenses, because the problem or complexity with the expenses is that the category of things that we're paying for is huge. There's different items that we're paying for because there's everything that we need to have done we are paying for, and we're not recording the expenses by vendor. but by what the service is we're paying for. And we're specializing, of course, in doing one particular thing typically. That's why we have one income account, like selling stuff, and we record it at sales, but still have the ability to break out that information by customer or vendor, depending on how much detail we put into the system and how we did it with subsidiary reports. So that means, so if I go over here, then we'd like to have a system that would be as easy as possible, that the deposit just goes right into revenue, and that's all you have to do. Okay, so what kind of company would that work for? It's going to work for like gig workers, right? So people that get paid from like platforms. If they're influencers and you get paid by YouTube, or if you do gig work and the platform just pays you and it goes directly into your checking account, then you might be able to simply do a cash-based system. You most likely are also not in that case subject to sales tax in the United States, because in the United States, the federal tax system is an income tax system. And the state and local are sales tax, but even then, the sales tax might be dependent on location, which could get a little bit complex. But if you do service items, oftentimes you're not subject to the sales tax. If you're in another country, you might have to deal with some kind of a sales tax even on service items or internet kind of business. So you got to be careful on the tax will muddy up the system. But that would typically be the easiest thing to do. So how would that work? Well, you're just going to see the deposit go through the bank feed over here. We'll go on over to the bank feed. Let's bring this on this side. So if I go into the bank feeds this side and we go boom, accounting, banking transactions, then the deposits would come into what we would call bank feed limbo. And then I would just record the deposits to revenue. Now notice, if they are electronic transfers from like YouTube or whatever gig work platform, the memo line will give you the detail typically, which you can then take and you can add the vendor, or the customer in this case, right? So that's great because you can put the payee in place. What's not as great here is that you're using a deposit form in this case, because the increases are typically deposit forms. In order to record revenue. And in QuickBooks, the deposit form isn't the natural form to record revenue, because revenue should be recorded by an invoice or a sales receipt form. So therefore, if you record by a deposit, you're losing a little bit of detail, meaning even though you put the customer in there, you might not be able to create a customer summary account quite as easily. And so you have that kind of issue. And then if you have to deal with like sales tax and whatnot, then you might have issues with the deposit form. Now, I kind of wish some other, their major competitor, I believe Xero, does have the capacity, I believe, to do sales tax, some other calculations on the deposit form. But QuickBooks full service system usually means they want you to use the invoice and sales receipt forms if you're going to record sales tax. And whatnot. Is that right, Ara?
Yep, that's spot on. Deposits are quick and dirty, but QuickBooks really wants you using invoices or sales receipts to nail the tax stuff automatically. Deposits? No built-in sales tax wizardry. If you sneak it in later as a journal entry, fine. But then you're the one doing math, and nobody likes that at 11 at night. Xero might let you fudge it cleaner, honestly. Want me to rattle off why sales receipts beat
that's going to be that's the general idea. So if you're just getting the gig work information, you could actually make accounts by customer, meaning you could just basically track who paid you in the account, because you wouldn't have that many different accounts for gig work. And that kind of is a deviation from the general rule of you would only have one income account and then break it out, the income account, by customer. But if you're using the deposit form and you're gig working and putting it through just the bank feeds, you can automate the whole system and make your few accounts for the actual platforms that are paying you. And then you can track that information actually on the income statement. All right, let's go to the next easiest situation. Let's imagine you're still on a cash-based system, but you still have to do an internal control. That would be like if you're in a store or like a food truck type of situation. Why is it still cash-based? It's still cash-based because if you're in a food truck or you're in a restaurant, or you're selling something on a physical location, you're getting paid at the same point you do the work, right? They're going to give you the money or the credit card, and they're actually, paying you in some way. You might not get it directly into your checking account at that point, but payment is happening when you do the work. You don't give them the food if they don't give you a payment. That means it's a cash-based system. However, it's not as easy as the cash-based system for the gig work typically, because I can't just wait till the money hits the bank. If they pay me by credit card, the third-party credit card company is going to take that money and group it together with other sales and eventually put it into my checking account. And if they pay by cash, I'm going to have to take that cash and deposit it into the checking account. Even if they give me an electronic transfer at the point of sale, then it might not hit my checking account directly, right? Typically, it's going to go through an intermediary kind of platform, which might group the payments differently. So what I'd like to do is record what we call a sales receipt type of form. So that's still a cash-based form because it's recording the revenue at the point we receive it, but it's not putting it directly into the checking account because whatever form of payment that I'm getting is going to go through an intermediary of some way. Either it's in the cash register or it's going to the checking account or the credit card company first before it hits my checking account. Or even if it's going directly into my checking account, there might be a third party, intermediary like a PayPal or Stripe or something that goes there before it hits the checking account. So if I just recorded everything and waited till it hit my checking account, I could do that, but then I'm missing the internal control. I'm not really tying out the cash register receipts to the payment. So what I'd like to be able to do is say, I want to run a sales receipt by type of payment, including cash. I want to check that to the cash drawer so I can do an internal control for people that are possibly working there to make sure they're not stealing the money. Otherwise, I don't have any internal control between that point and the point that it got deposited, and I'll be missing, theft. I won't have the internal control. So whether we're getting paid by cash, in which case I'm going to have to deposit it to the bank physically each night, hopefully each night, or credit card or any other platform, it's going to go onto the other platform. They're going to take it and put it into my checking account, and it's going to go into my checking account in a way that's not going to be grouped the same way as the sales. It's not going to, if I have $5 meals or $10 meals or whatever, they're not going to be recorded in my checking account by $10 meal unless they give me an electronic transfer directly to my checking account by payment, which isn't typical, right? Hopefully at some point that will be more typical. That would be the best thing if all people paid directly from their checking account to your checking account, no intermediary institution, but we're not quite there yet, right? So that means that it's going to be grouped in some way before it hits my account. So that means I want to do this. I want to do an internal control on the cash register, and then it's going to go into not the checking account, but what we call a clearing account, which used to be called undeposited funds. QuickBooks Online sometimes calls it different names, whatever you want to call it. It's going to be not a checking type of account, but a clearing account that we can then use to take it out of the clearing account and put it into the bank in the same grouping that it's going to show up on the bank statement. That's important because we need to be able to verify our books to the bank books. So even though we're on a cash-based system then, we're doing more of a full-service bookkeeping system, meaning I'm recording revenue on my side, I'm recording the deposit on my side, I'm checking it to the bank, possibly with the use of the bank feeds. However, the bank feeds most likely are not going to record the actual transaction. It's just going to verify the transaction in that system. You can imagine I put a sales receipt in there and then wait till it clears the bank, possibly, and try to match the deposit either to the sales receipt or to the received payments from the bank feeds. We'll talk more about that when we get to the course or section of bank feeds. But most likely, you're going to have to do the whole process, right? You're going to have to record the revenue to do the internal control into a clearing account, which often confuses people until they get the system down, and then take it out of the clearing account and put it into the checking account when we actually make the physical deposit into the bank, when we actually physically go there and make the deposit, and or when the money comes out of the intermediary financial account, like the credit card account or the PayPal or the Stripe, into our checking account. As we do that transaction, particularly with a credit card, or intermediary account, they might take their cut, a fee, which we can deal with at the point in time we take it out of the clearing account and put it into the checking account. All right. So we still haven't done a full accrual system. What about a full accrual system? So that means, by the way, that if you're doing work for a restaurant or a food truck, the specialization comes in the internal control over the point of cash, of the point of sales. What kind of sales do you want to recognize? How many credit cards do you want to recognize? Do you want to just have cash sales and not deal with other kinds of sales payments? What kind of, those are the things you're going to have to deal with. And then how do you deal with that intermediary account, which drives people crazy? They get it messed up all the time. So what about a full service accrual system? That means we're going to have to invoice the client. Now, you can't just choose, well, I'm just going to do a cash-based system. I don't do no work unless I get paid. That's how it is. Well, that's great, but it only works by industry. Like if you're in an industry where you have to do the work first, that's just the way it is. Like if you're a lawyer, you're going to have to take on cases, and possibly the cases are going to be dependent in part on the outcome of the case. Possibly you can't really, you have to charge the time. And therefore, you're going to have to invoice. Same with a CPA firm, a tax firm. Oftentimes, you're going to have to bill the job possibly, and then invoice, do the work, invoice, and then hope you can collect on the payment. That's just the way it is for particular industries. So therefore, if you're dealing with those industries, you want to think, do I want to deal with those industries? Because if you do, you have to deal with an accrual component, which has accounts receivable on it, which throws a whole nother wrench into the system in terms of collection and problems between the sales side to the deposit side. So meaning if I was a landscaper, for example, and I do work and then I bill for the work that was done, then I'm going to invoice the client. Now, also just terminology wise, the invoice in normal parlance and just normal speak could be on either side of the table, just like the bill, meaning the telephone company could invoice me. That's a normal way to say things. But from our side, even though the sheet says invoice because they use the invoice form, if they were using QuickBooks, to us, it's a bill. So we would normally say they billed us. And the invoice, when we invoice the client, it's common in a job cost system like a construction company to say we're going to bill the client for the work that we did. We're going to bill the client, but we're not going to use a bill form from QuickBooks standpoint. We're going to use an invoice form from a QuickBooks standpoint. So when we get into the actual form that we're doing the data input, it's more specific than normal parlance language or even accounting language. The invoice means we did work and we're going to send the invoice charging the client for the work that we did, expecting payment to happen not at the point we make the invoice, but in the future at some point. We're going to collect on it at some point in the future. So if you deal with that, if it's a service company like landscaping, CPA firm, law firm, you're going to do the work, but at least you don't have to deal with inventory. And then when you do the work, you bill the client. That's when you make the invoice. The invoice is going to record revenue at that point in time, but you didn't get paid. So where does the other side go? It goes into not cash, but accounts receivable. So it doesn't go into the clearing account. It doesn't go into cash. It goes into another asset of accounts receivable. And that has a subsidiary ledger because you don't want to just track that by amount, but also by who owes you the money. So now you need to track who owes you the money because you have to collect on it. And everybody knows, like, if you work with accounts receivable, there's going to be a certain amount of people that are just deadbeats. They're not going to pay you. And they're people that you want to trim out of your business and most likely personal world, right? The people that are just trying to scam you all the time. Right, Ara?
Yes. Those clients you forgot to pay, or worse, send post-dated checks that bounce harder than a rubber band. I mean, I feel like half my job would be writing polite but firm emails like, "Hi, just checking. Remember that invoice from 3 months ago? Keep that AR aging report handy. You're going to need it."
And so this is the point where, for example, we don't just enter the form of an invoice, but now even on small businesses, you have to really communicate with customers because invoicing is only half the battle, right? Collection is the other half of the battle. You can't get around it. So hopefully you have good customers, but they're never going to be
Exactly.
They're never going to be great. So we have the sales and get paid. So that's when you're in the sales and get paid and the customer hub to help you to track those invoices. So that is a whole specialty in and of itself, which kicks in even with small businesses if you're in a business that has to deal with the receivables. Whereas on the payable side, the accrual component doesn't really kick in until you usually get to larger businesses that are dealing with more necessary cash management strategies because of the time value of money and the volume of transactions. So that means on the customer side, you have the opportunity to specialize in particular industries. Now, it's still going to be confusing because if they have accounts receivable, it's still a question of, are they a service company or possibly they have an added component of inventory. Service company would be easier. Now, if they're a service company and they might be a job cost system, in which case you're also going to have an estimate form, which is often the case for a CPA firm, a law firm, a landscaping firm, construction companies, because that means that you don't know how much it's going to cost because the job is unique. Every job is somewhat unique. The costs are going to be different for every job if you're in construction or if you're doing a law services. Therefore, the best you can do is create an estimate. This is what we think it's going to cost. Okay, the estimate's not going to record anything, but it'll give you an idea of and that estimating process is an art in and of itself, particularly in law firms and CPA firms and construction firms, to try to get the estimate to be as lean as possible, but not deceptive in the end result, and then to be able to create the invoice from the estimate after the work is done, or possibly as the work is going, because sometimes if you have long projects, then like if you're building actual buildings, or if you have long construction processes or long law firm problems, then you might have a revenue recognition issue because you might be saying, I'm not going to recognize revenue when I complete the work if it's a super long job because it's going to take multiple years possibly to complete the work, in which case you might do a completed contract versus percentage of completion. That's a whole specialty in and of itself once again, because now you have a whole different revenue recognition structure, which most people don't know about too much at all. So remember, if there's accounts receivable, then the question is, there's still specialization within that industry. All right, now as accounts receivable happens, you'd have receivables, and then you'd have to receive the payment, and then you'd have to make the deposit. When you receive the payment, you might just put it into the clearing account again because they might pay you by cash or they might pay you by credit card. More likely, however, that they might pay you in some way that goes directly into your checking account with an electronic transfer. Depends how your payment is received, however. If they can pay you by credit card, though, then you have the same problem with the sales receipt, meaning it goes through another financial institution, and therefore I can't put it directly into the checking account because that institution will group the payments together weirdly, possibly taking a fee out before it hits my checking account. Therefore, I got to put it into the received payments and then record the deposit, most likely then matching the bank fee deposit to the process after I have done the whole process. So I'm doing a full service bookkeeping system. But you can imagine trying to use the bank feeds to match to the received payment or to the invoice to record the rest of the payment automatically. Some payment processes make that easier to do. For example, if you have on your invoice the electronic transfer on the invoice to allow them to pay electronically, particularly if you have a checking account through QuickBooks, then QuickBooks might be able to make the received payment and deposit form transactions easier upon receipt of the payment. Is that right, Ara?
Yeah, mostly. If you're using QuickBooks Payments or something tied in like that, it auto-catches the payment, marks the invoice paid, spits out a received payment entry, and even drops the money into the right spot. No manual limbo hopping. The catch? You gotta pay them their fee, obviously. Still beats rustling receipts. If you're not on their ecosystem though, like if clients ACH straight to your bank, bank feeds can usually sniff it out too, assuming the memo says, "Thanks for the legal work, Smith LLC,"
So
instead of just whatever.
the basic idea is that you could have the link directly on your, and then if you have QuickBooks check-in account, then it'll automate it. So we have another course or section that kind of gets into that, but that's a more specialized area. You might say, well, what if I don't want a QuickBooks, checking account with Intuit or whatever? Well, you could use any checking account that clears the bank, but then it might not connect to the invoice quite as efficiently, right? But you could but it'll still probably figure it out on the bank feed. So again, we'll talk more about that later, but that allows another area that you want to be aware of for specialization on the customer side. Now, the other thing, of course, is inventory that throws a wrench into everything. So if you deal with inventory, then you have to ask the question of, how am I going to track inventory? Because in the United States, for income taxes, you typically, even if you're a small business reported on a Schedule C, have to record a balance sheet type of account for the cost of goods sold calculation. And if you're in larger businesses, you're going to have to do the balance sheet, which will have an inventory account. Now, the problem with inventory is that you're typically going to be on an accrual basis then, because the tax return will typically force you to be on an accrual basis. Why would you be on an accrual basis? Because the inventory is something that you buy that hasn't helped you to generate revenue. Therefore, when you buy it, you have to track it on the balance sheet as inventory. And then when you sell it, that's when you expense it as cost of goods sold. Now, the problem with tracking it as inventory is that you can't track the units on the balance sheet as inventory. You need to track the dollar amount. So now you have to track what you paid for the inventory on the balance sheet. But you need to be able to support what you paid and double check by unit. So therefore, where am I going to track the units? You could do that within QuickBooks. You could do that on a third-party platform if you're using Amazon, or if you're using some kind of third party. They might be able to track it. We have integrations with QuickBooks. If you're doing sales through Amazon, I think eBay, which we have another course or section on, which has some specialized areas in terms of best practices that we explain in that area as well, if you want to look at that in more detail. So that's another area of specialization. And or you might track the inventory on a separate worksheet. So quick rule with the inventory. When you deal with inventory, then you might be on the simplest method. Maybe you have a drop shipping kind of thing where you order something from Amazon and then you ship it to them directly. And when the customer pays you, maybe they pay you directly at the point of sale on your website, right? And then maybe instead of the inventory coming to you, it goes directly to them. Well, in that case, you might be able to get away with basically being on a cash-based system, saying when they pay you, I'm just going to record it as revenue at the point in time they pay me. And when I have to pay for the inventory at the same time, I'll just record it as cost of goods sold at the point in time that I buy the inventory, because I'm not really stockpiling the inventory. However, if I am stockpiling any sufficient amount of inventory, then the IRS is going to want to see that worksheet that's going to tell us the inventory at the beginning and end of the year, right? So in that case, we're going to have to do that in some way, either using a periodic system or a perpetual system. A periodic system would be more basic, meaning you're going to track inventory on another website like Amazon or the Shopify or whatever, or your Excel worksheet. And then you're just going to adjust the numbers in QuickBooks periodically, which you could imagine doing just at the end of the year so that you can do your tax return to do the cost of goods sold calculation, or possibly nightly or monthly or weekly, whatever basically works. And in that case, that would be easier or more simple from a QuickBooks standpoint, because you're not actually tracking inventory within the system. We'll talk more about that as we go. But you could say, what if I want to do a full service system in QuickBooks? That means when you sell inventory, whether it be in a store with a sales receipt getting paid at the same point in time, or with an invoice, meaning you're going to bill them and you're going to receive payment later, you have to record the inventory, which is going to decrease the inventory on the balance sheet, and also record the cost of goods sold at the point in time of sale. It'll also record on the subledger the decrease to the inventory units, so that you can actually match that to the physical count. That's going to be the full service system, which QuickBooks Online is okay at for basic inventory that's a perpetual system. But if it gets more complex, that's when you would need to kind of upgrade and have special inventory needs. So if you're dealing with inventory, you really need to think, what kind of clients do I want to take on, and where's my specialty in inventory? What systems do I want to specialize in? That's where you can possibly charge premiums to be an expert.
Right. Inventory's the chaos multiplier. If someone's just drop shipping from AliExpress, treat it like a glorified middleman. Cash basis revenue when the customer pays, cost of goods sold when you pay the supplier. No stock count, no headache. But once they're actually stacking pallets, then yeah, you either do periodic, basically guess the inventory value, beg forgiveness later, or perpetual, where QuickBooks pretends it's a warehouse. And honestly, if they're doing that, I'd rather outsource the tracking and just let QB be the cashier, because nobody's getting paid extra to count boxes at 3 a.m. But the real money? Helping Amazon sellers who think inventory means whatever's in my garage. That's where the fun starts.
Okay, so going forward, we'll take a look at the center, and then look at that, and then we'll look at each of these forms, and I'll try to map out all the different possibilities for each form, as well as possibly where bank feeds could potentially fit in to get a visualization, remembering that you want to take that overall understanding and apply it to your particular circumstance and or to your specialization as a bookkeeper or accountant.